Public expectations for hosting the Olympics involve promises of double-digit property booms. However, historical data reveals a recurring pattern of post-event asset depreciation. Following the 1992 Games, housing prices in Barcelona decreased by 50% within 18 months. Rio de Janeiro's property market underwent a similar contraction after 2016, entering a multi-year period of declining values and stagnant demand. Hosting the Games forces a concentrated redirection of capital flows, labor markets, and infrastructure timelines into a highly compressed window. It alters the city's economic baseline through sudden, high-intensity public spending. These real estate effects are volatile events. Profitability in these markets depends on identifying the specific phases of this economic disruption. Historical price curves reveal a 10-year Olympic cycle with 3 phases. First, a psychological price spike at the announcement. Second, a 5-year construction phase where values trend upward alongside public spending. Finally, a post-event legacy phase where market paths diverge into renewal or surplus. Distinguishing between temporary event hype and permanent structural changes to the host city determines whether an investment survives this 10-year cycle. The underlying mechanics of an Olympic boom depend on the host country's baseline economic maturity. Emerging economies often utilize a national urbanization model. This relies on massive greenfield development, building on undeveloped land to scale the city outward and accommodate new population inflows. In contrast, developed economies employ urban regeneration. They target brownfield sites, previously industrial or blighted land, and use the Games as a mechanism to gentrify high-value, supply-constrained urban cores. Developed markets frequently show higher resilience because the new infrastructure reinforces existing economic centers rather than creating isolated new zones. Long-term yields are determined by the nature of the infrastructure. We must separate consumptive assets, like single-use stadiums, from productive assets, like rapid transit systems. Data from the Pyeongchang 2018 Winter Games illustrates this. Residential units near the new high-speed rail line saw significant price premiums, whereas housing adjacent to the athletic stadiums recorded negligible gains. A specific risk factor is the supply shock. This occurs when thousands of units from the athletes' village are released into the residential market immediately following the closing ceremony. If the local population cannot absorb this sudden influx of inventory, the resulting localized surplus suppresses property yields for years. Productive transit assets support permanent value increases, while specialized venues often become long-term municipal liabilities. Leading up to the Sydney 2000 Games, median house prices rose nearly 70%. This growth is often used to validate the belief that the Olympics are a primary driver of real estate wealth. This table records quarterly growth for the Sydney Statistical Division. It shows the Olympic corridor underperformed adjacent suburbs like Leichhardt and South Sydney. Sydney's broader growth was largely driven by nationwide credit deregulation, while the corridor struggled to match areas with established gentrification. Rio 2016 provides a different outcome. Pre-game prices troubled during the speculative phase, but were followed by a severe multi-year crash as the local economy failed to sustain the event-driven inflation. The Olympic effect functions as an accelerant to existing local conditions. Pre-existing economic fundamentals remain the primary determinants of long-term value. We can apply this assessment framework to the upcoming Brisbane 2032 cycle. Brisbane's baseline starts with significant pressure. Property values have increased 92% over 5 years, resulting in high price-to-income ratios. This appreciation is linked to fundamental supply imbalances, record low vacancy rates, and sustained interstate migration. A primary risk for the 2032 cycle is the potential for stadium construction to crowd out private residential projects. This competition for labor and materials could further constrain the housing supply and inflate costs. The success of the Wollongabba renewal depends on its ability to create a permanent commercial hub. The infrastructure must serve the city's daily economic needs, rather than functioning solely as event space. Brisbane's outcome relies on addressing its pre-existing housing shortage and ensuring that new transit assets align with long-term demographic requirements. Institutional analysis of Olympic host cities relies on a set of objective criteria to strip away speculative noise. First, the transit multiplier. We must verify if the asset is located on a newly funded, productive transit corridor that improves commuter access. Second, the supply digestion rate. This assesses whether local population growth is sufficient to absorb the athletes' village inventory after the games. Third, macro alignment. This determines if local interest rate cycles and credit availability are supporting or hindering the property market. Fourth, we determine if the project is brownfield or greenfield. Infrastructure replacing blighted urban zones generally offers higher regeneration potential. Finally, the white elephant radius. The property should be insulated from the maintenance costs and debt burdens associated with underused single-use stadiums. Analyzing these 5 variables provides a structural view of the market's growth potential. The Olympic effect is a localized accelerant. It builds upon but does not replace the underlying economic health of the city. An effective investment strategy ignores the temporary spectacle of the games and focuses on long-term utility and sustained yield. The information in this video is for educational purposes and does not constitute financial or real estate advice.